on today's edition of Money Life.
I think that we are going to see inflation perk up. I think the big question is because the employment picture is a little bit iffy. Has the threat of tariffs and the uncertainty, has that decreased demand? And so that's been perhaps an offset to the inflation impact. We shall see.
That's Nanette Abahoff Jacobson, global investment strategist for the Hartford Funds. And she's here for the big interview talking about the global picture, why she favors international markets over domestic ones right now, and much more. But we start today with Michael Guyad, portfolio manager for the Free Markets ETF, which is looking to make its plays based on which industries will benefit from deregulation. And he'll talk about how deregulation will be a significant business factor moving forward. Plus, Jesse Abercrombie, financial advisor for Edward Jones, is here discussing their Pulse of North America survey, which showed that nearly 3/4 of Americans are optimistic that they can live a financially fulfilled life despite all of the recent volatility in headlines.
Come on, wake up!
Yeah, that wake up was about you guys out there waking up and getting into living the money life. It was not about, hey, should those people wake up that they shouldn't be optimistic or anything like that. I was not making a statement. No. Welcome to Money Life for July the 16th. I'm your host, Chuck Jaffe. Thank you so much for being here. This is a really interesting show. And, normally I save the crossover for the end of the show where I talk about how guests have matched up. But I want to tell you straight out, because you've got this whole thing with Michael Guyad talking about deregulation. Well, yesterday you heard Hank Smith in the market call from the Hartford Trust Company discussing deregulation and how it was impacting banking. And now you've got a very different sort of take on it today from Michael Guyad. He's not talking just about banking. He's talking about everything. And then the other thing I want you to listen for today, you had a mention from Mark Newton on yesterday's show of a Goldilocks scenario. Like, this is a Goldilocks market. Well, you have Nanette Abahoff Jacobson in her interview talking about how this is not a Goldilocks situation or shouldn't be considered a Goldilocks situation. So it's important that you get that disagreement and figure out where you fit in the disagreement that makes a market, because disagreement does make a market. You can make strong cases that, like, oh, I'm looking at the headlines, things have got to get worse than they are, but I don't want to feel bad while everything else is going up. So, I'll make my hay while the sun shines. All that stuff is there. By the way, I also, speaking of crossover, I want to go back. I feel that I left something out as an interviewer, and it happens all the time. You realize, oh, I should have asked this or should have done that. But there's a number that I meant to run by Brad Case, the chief economist at Middleburg Communities, that I didn't, where the Atlanta Fed recently posted some data that showed that housing costs, which is not just the cost of your house, that's insurance, but shelter costs now make up 46% of median income, when the historic number has been about 31%, and 30% is what's considered affordable, right? When you're looking at credit reports and credit scores and all that other sort of stuff. And so you have a question in there about, well, is this your proof that there's a housing bubble of what folks are doing? I wish I had asked him the question, and I didn't. I can get him back on if you want, but I'd like to know what you thought of that interview as well, because again, you had an economist making a case that certainly goes with the stripes that he has to wear. So if you've got an opinion, let me know. Chuck@moneylifeshow.com. I would love to hear from you with your questions, your comments, your suggestions, and more. Now, today is July the 16th, which may not mean anything to you, but to me and the folks in my house,
Happy birthday to you.
yes, it is a birthday. It's not my birthday. My birthday was back in June. It's Gail's birthday today. So I will be making cherry pie for her, and I've got a nice dinner planned, and we'll have her kids over. So, yeah, I've got something good to celebrate today. Now, of course, we tell you at the end of the day, everything you should celebrate. I got a lot of stuff that is going on today and more. I'll tell you more about that at the end of the show, but it doesn't, not just on birthdays. I think Gail knows that I very much appreciate everything about her in my life every day and not just on her birthday, but an extra special occasion to celebrate my wife. Thank you. Sign me up. Meanwhile, you've signed up to get great financial talk. We've got it for you. So let's get to it now. Again, our lineup today: Michael Gayed, Jesse Abercrombie talking about financial fulfillment. That's a key part of that one. And then Nanette Abahoff Jacobson of the Hartford Funds. It's a great day to live the money life. It's Gail's birthday to live the money life. We'll prove it all that it comes together right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome to the other interview to start today's conversations here on Money Life. I'm joined right now by Michael Gayed. He's portfolio manager of the Free Markets ETF. It's ticker symbol FMKT. It's freemarketsetf.com. But if his name rings a bell, but the Free Markets ETF doesn't, well, that's because he is also portfolio manager for the ATAC funds, ATAC, atacfunds.com. That's the ATAC rotation fund and the US rotation ETF and others. He is also the publisher of the Lead Lag Report, which you can learn about at leadlagreport.com. And Michael historically has joined us to talk technicals, and we could do that with him, and we may get there. But we also want to talk about what is going on as it becomes the current administration's policies reshaping the regulatory landscape and how that's impacting industry, because that's what the new Free Markets ETF is all about. So again, freemarketsetf.com if you want to learn about the fund, if you want to learn about how free markets and deregulation, et cetera, are shifting the impact on American businesses, buckle up. Michael Gayed, it's great to have you back on Money Life.
It's been a minute, man. I'm glad to be here.
It has been, but you're so busy. It's hard to get you back on and get that time. So I appreciate you giving me the time, and I do not want to waste it. I want you to give a quick overview of the Free Markets ETF, and then I really want to get into the concept, which is much more about what we're talking about with policies. And it's obviously this administration's policies, but it could be any administration's policies, how they create investment opportunities and the opportunities that are being created.
So I came up with the idea, obviously, when Trump got elected, because it was very clear that he wanted to focus on deregulation as a major direction for his administration. We saw what he did in the first administration, and instead of thinking of myself like a portfolio manager, I thought of myself more like a product developer. Meaning, I said to myself, okay, well, if deregulation is going to be a thing, how do we create a fund to take advantage of that? Partnered up with 3 firms, Title Financial Group as the advisor, 2 other sub-advisors, as well as my own RIA as the sub-advisor on that fund, and basically spent several months building out a whole AI around the concept, looking at, from an AI training perspective, executive orders, legislative action, speeches, then at the same time screening for companies that are in highly regulated industries that have a strong history of operational excellence, and then basically telling the AI, hey, which of these companies likely benefit the most from what's going on the deregulation front. And it's been so far so good. We launched the fund FMKT June 10th. As we're speaking, it's outperformed pretty much all major averages. And I think it's a sort of a testimony to the idea that alpha does come from deregulation, from the change of going from a highly regulated industry or sector to hopefully at least a less regulated one. And I don't think Trump's done by any stretch of the imagination deregulating the entire economy.
Well, I think he's barely started because he's been more focused on tariffs and things along those lines. And that's not the regulation you're focused on, correct?
Right. And a lot of these deregulation measures are coming out in the form of executive orders, primarily on Fridays, which is why when we actually meet as an investment committee the following Monday, we look at what the AI is suggesting, and then we think through and make a decision on the suggestions and the filtering. But no, it's a lot. The clearest one was around nuclear, right? And the idea of getting the NRC to Nuclear Regulatory Commission to speed up some of these build outs when it comes to nuclear reactors and uranium mining, all that stuff. There was another recent deregulation executive order around drones and flying cars effectively, which is why we included Archer Aviation and Joby. So a lot of these things that Trump is doing, to your point, they're early, but they're meant to try to get rid of a lot of the red tape, which has held back a lot of companies from really thriving, and I'd argue from competing against the really big players, which have all the revenue in the world to deal with compliance costs, while the smaller players don't.
Let's point out, sometimes I have to remind the audience or just the public that, like you'll look at something and they'll say, this is an AI fund. And the question will be, is it a fund that invests in AI or is it a fund that is using AI to invest? I want to point out that while you are looking at deregulated industries, you are not really looking at the industry of regulation, which is like $1 trillion industry by itself. Like just compliance costs and all this other sort of stuff are going to be massively changing, even if we're reducing regulation and doing other stuff. Compliance is its own industry, but that's not what you're heading towards.
Right. I mean, the hope would be that you're trying to identify companies that benefit the most from compliance costs lowering due to deregulation. And to your point about AI, it's not investing in AI companies. It's just using AI as an analyst, as a tool to help us figure out which of these particular companies we're screening for, which are, we believe, high quality, likely to have the most bang for the buck from relative deregulatory measures being taken.
So give us a for instance or two in terms of companies that you see as the kind of thing that would benefit from deregulation and the stuff that's on the table.
And the most obvious one, which has been a top position actually since we launched the fund, is Robinhood, right? Because it sits at the intersection of finance, which is highly regulated, crypto, which is, as we're speaking, it's crypto week. And, crypto is obviously a major priority for the administration. And it also has a lot of interesting aspects when it comes to AI, which does relate to deregulation around privacy and consumer protection laws. So that company's obviously been on fire. We benefited nicely from that. Other companies that are interesting plays include companies like McKesson, which we expect, given some of the focus around deregulation when it comes to prescription drug pricing, can help the largest distributor of drugs in the United States. There's a lot of interesting companies in the portfolio. And I will say that it's not just a pure equity portfolio. We do actually also include Bitcoin and we do include gold in that, purely because as ETFs, GLDM on the gold side, IBIT on the Bitcoin side, within FMKT, relatively small positions, but they can change. Those are representations of free markets, right? I mean, just from that perspective. So this is meant to be as close to a pure play on the idea of investing in markets that don't have that type of red tape, which ends up being a big driver of costs, which ends up obviously being a big reason for why products and services don't come to market faster. And that has all kinds of implications on the bottom line.
As I said, you've been on the show previously talking technical analysis because the ATAC funds very much onto technicals, et cetera. I am curious, you wear a number of hats and your funds are all very clearly defined on what they do. How much do they ever conflict with each other where you say, okay, on the left hand, and I'm not talking about political sides of the aisle or anything, just, hey, with this one where I'm running this one, I'm going in this direction. But on this other one where I'm managing, with my right hand and I'm multitasking, I'm going in a different direction. How much is everything for you in sync? How much of it, as you get into more and more things, are you like a little bit of this and a little bit of that? And sometimes we're trading with each other.
It's not that they're in sync. I do think there's a common theme, though, conceivably. Even though the ATAC fund family is extremely tactical between asset classes and FMKT is a thematic, primarily equity fund that does not go risk off in the way my ATAC funds do, there is a common thread there, which is that if you think through it, which sector of the stock market has the most regulation? It's the utility sector. Which sector of the stock market has the least volatility? Utility sector. Okay, now why am I mentioning that? Because I suspect there's a direct link between regulation and suppression of volatility, which, by the way, matters from a risk on, risk off perspective. So, to the extent that deregulation becomes a bigger and bigger driver of Trump's future plans, then I'd argue that that results in two dynamics. One is it should result in more volatility, because freer markets should be more volatile, which might mean more risk on, risk off pulses, which perhaps my ATAC fund family can benefit from. The other part of that is deregulation, in theory, should most benefit mid and small cap companies, not the mega cap players, because it's the mid and small cap companies that will get the real breathing room to do what they need to do to try to compete. They don't have to worry about all the red tape and compliance costs that they're dealing with. That potentially causes a big rotation from large caps into mid and small caps, which also would help from a tactical perspective because those might be better ways of playing risk on. So even though they are very different funds, I'd still argue that the overarching thesis around deregulation being a driver of the economy going forward will have all kinds of implications on asset class movement.
Where are you? You talked about ATAC being looking at signals and what have you. Where are you on risk on versus risk off right now on the equity markets?
It's a little bit unclear. I argued on X on my Atlee Lagerport handle that it looks like the transition has begun to going back to potentially a risk off sequence, I think, in August. Of course, I've been along on that, but it does seem like the conditions might line up for that. But it's a mixed bag right now. I think, while the S&P is at new highs, small caps clearly are not. They're trying to play catch up. And I will say that I do think the sentiment is once again back to frothy, extreme, high conviction levels. And I typically get nervous when I see everybody on the same side of the boat.
You have been on the other side of the boat from a lot of the bulls for a while. There are folks who have said you have been particularly bearish. Bearish could also be early, et cetera, depending on what things happen. Is there a reason why you feel you've been out of sync, or why it appears to me, perhaps as an observer, maybe you haven't felt out of sync at all with the rest of the investment world?
I think it depends on what you're looking at, because if you look at small caps, going back to that, Russell 2000 is halfway through a lost decade. And small caps have gone nowhere. The majority of stocks in the stock market are small and midish, not the large cap market cap weighting, which is what has been in a bull market. Most other stocks really haven't. Matter of fact, the small cap side of the market is still in its 2022 drawdown after inflation. So, yeah, I get accused sometimes of being a perma bear, but I don't think you can disregard the fact that most stocks have not participated in this, in quotes, bull market.
That being the case, what's it going to take for you to see things to become bullish? Do we have to have a protracted bear market or correction that cleans a bunch of the froth out for you to get to where, you prove you're not a permanent bear by going, here's my bullish case?
Yeah, well, so look, it's a question of sort of sequence and timing. I mean, I'm bullish on small caps and mid caps very much so, because I think deregulation is going to be a big driver of that potential outperformance. If deregulation really does persist in a big way, then sure. I mean, that's your bullish argument. That's your next leg higher. And that's going to be one of those things where you can play catch up, I think, by being outside of large caps for the first time in a very long time. That's not to say you can't have some kind of dislocation in between that longer term view, right? So oftentimes I find that people, they get hyped around bullish and bearish, and they accuse somebody of being a perma bull or perma bear, but they never ask time frame. Right? I think August could be high risk for some kind of a dislocation, like it was during the August of last year for the reverse carrier trade. That doesn't necessarily mean that now you're not bullish on equities, because you can be bullish on equities for a 3-4 year cycle because of deregulation in and of itself.
One of the things you have been spending more attention on, as I watch what you do from the outside world, is you've spent a lot more time looking at things like closed-end funds and income drivers along those lines. We have seen tremendous activity there. They've become very popular and what have you. How much do you, as an outsider, because there are certainly times when you are very critical of some of the stuff you're seeing in terms of how some of those products are generating their yield, et cetera. How much are you just full on skeptic? How much of you are, no, find the gems, and there are some gems?
I think I tend to approach things more from a skeptical point of view, where if it's too good to be true, it probably is. I think it would be good for more investors, especially retail, to have that mindset, because I personally find that a lot of retail trading and investing seems to go into parts of the marketplace which, from a total return perspective, are suboptimal. But because they like a certain yield, it doesn't matter to them. They view yield as different than NAV. All right. So I don't know. I think in general, it's always good to sort of poke holes at an investment thesis and argument, because that's the only way you can try to avoid getting sucked into the pitch, which is always what everybody's trying to throw at you to get you to buy.
Why, in all of that, given that you are looking at what other things you can run, et cetera, as you've been taking the critical look at closed-end funds, haven't you done a closed-end fund of funds?
I only have so much liquidity, and right now it's tied up in the existing funds with the free markets ETF. But maybe one day you and I will launch one.
Well, probably won't be me on the launch side. I'll be the one who's covering it and talking to you about it. But Michael, it's been great catching up with you. Good luck with the new fund. I look forward to chatting with you again down the line. Thanks for joining me on Money Life.
Appreciate the invite.
That's Michael Guyed. He is the portfolio manager for the Free Markets ETF. It is FMKT, freemarketsetf.com, but he's also portfolio manager for the ATAC funds, ATAC Rotation, ATAC US Rotation ETF, that's RORO, and others. Learn about them at atacfunds.com, and to check out Lead Lag Report and much more, go to leadlagreport.com. And we are just getting started on the July 16th edition of Money Life. Later, Natalie Abahoff Jacobson, strategist for the Hartford Funds, will be here. So we've got a lot more to go. Settle back and relax. We're living the money life, and we'll be right back at it in just a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Now Money Life looks at what the survey said. Yes, this is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today we are looking at the Pulse of North America, which is a study that has just been released by Edward Jones. The financial firm conducted it in April as we were seeing the market go a little bit crazy. But it's an important thing because as they were looking at the zaniness of the market, they were comparing it to a financially fulfilled life. And that's a term we're going to have to explore because we hear all the time that there's a disconnect between the soft numbers and the hard numbers, that we are getting people being very unhappy about what's going on with their finances. And yet, of course, they're still spending. Well, what the folks at Edward Jones found was that a majority of Americans, virtually 3 in 4, are optimistic about their financial futures because they believe they can achieve financial fulfillment. Here to discuss it is Jesse Abercrombie, financial advisor with Edward Jones. It's edwardjones.com if you're looking for more information on the firm. But if you want to get directly to the study we're discussing, edwardjones.com/pulse. And it's all linked up in our show notes and on our guest page. Jesse Abercrombie, welcome to Money Life.
Hey, Chuck, how are you?
I'm well. And the good news is I also think that I understand your study, which means that I am financially fulfilled, even though I'm not retired and not whatever. But we need to start with that because am I happy with my situation is very different from financial fulfillment. So help explain what it is that you were asking after, because that distinction is really important here.
Yeah, absolutely. So Americans define financial fulfillment as really having freedom to pursue their passions, being able to make better life decisions for themselves and also for their families. And Chuck, having security and protection from those unforeseen events. We have things that occur every year in our lives that we just don't see coming, and they come out of nowhere. But that really is what that financial fulfillment is alluding to, is being prepared for these moments that matter.
Of course, being prepared for the moments, we just went through something that nobody was prepared for, which was what happened after we saw the first introduction of tariffs. Now, we've then seen subsequent step backs and what have you. And each time there was a new announcement, we wound up seeing less reaction in the market and maybe a little bit less reaction from the soft data polls. Is that because if you're living a financially fulfilled life, on the one hand, you get scared of the headlines. On the other one, once the headline gets a little older and you see how it's shaken out, it's not quite as scary, so you're not quite as disappointed?
Yeah, Chuck, you're right. Over time, when something is constantly repeated, it tends to lose its shock value as it relates to the concerns that people may have. But I will tell you, there's another thing too, is by having a financial advisor, that person that is, I call financial advisors in so many cases a partner, accountability partner that can help you as it relates to your needs, wants, and wishes and your dreams. But when you take this holistic approach, and the financial advisors really know what those clients' needs, wants, and wishes are, which that might be prioritizing their spending and saving when these things happen, right? Knowing, hey, there's something coming that I need to make some adjustments for, or just teaching financial literacy skills that we really help build that optimism. So when these things come up like tariffs, they know that they already have a plan in place and they're going to be able to have a financially fulfilled life that's achievable.
Well, I say all the time, having written 2 books on choosing and working with advisors, that advisors, people hire them because of their thinking about performance or the size of their nest egg, but the real job is to provide emotional discipline. You get into a situation like we saw in April, and it's important to be disciplined. And that's where the advisor is saying, look, we didn't plan for this exactly, but we planned for this and a lot else as we built the plan. So we're not surprised and we're not scared. And I think a lot of people in here are like, oh, I don't have to be scared. We did factor this in. They get a lot of peace of mind off of that.
Yeah, I agree. I think that's what made the results. They weren't shocking to me to see that literally 79% of people still felt confident. Well, that means they have an accountability partner, whether it's a friend, a family member, or a professional advisor. They have some plan in place. And that was really good news to hear.
One of the other things, and this does come a little bit from working with advisors as well, is that your study found as much as people can feel bad about, oh, the price of gas is up. I always say I can be upset about whatever the price of gas is, but I only buy one tank a month. So it's not really affecting me, right? As much as we could be upset with what we're seeing at the grocery store, et cetera, one of the key things is that the bulk of people, especially those who are financially fulfilled, they may be aware of what's going on, but when they want financial fulfillment, they're looking at, am I where I'm supposed to be relative to my goals rather than, you know, how much money am I making or whatever, right? There's always that specific to themselves that helps.
Yes, absolutely. While these investors are more optimistic, there's still challenges, right? And some of those are like the rising cost of living expenses. There's those unexpected financial setbacks like healthcare cost. In some cases, insufficient income were some of the bigger obstacles that were out there. And those things are going to come on an annual basis throughout the year. You're going to have things that will come up despite feeling financially fulfilled. There's always going to be challenges that will arise. And again, I think it's the people who are aware of what their plan looks like are the ones in the best shape to move forward and succeed.
When it comes to what folks have seen and what they might get next, I mean, we've got heightened volatility. People often mistake volatility for risk. But given that folks did so well on the financial fulfillment side of things during this time, what do you think happens? How much does financial fulfillment get impacted if instead of seeing short term, oh, here's another, downturn correction, whatever, that is over with in a matter of a month or two, we wind up getting something that gets stickier? I mean, you caught him right at the beginning. If we wind up in a situation where we're doing this study again down the road, and oh, by the way, we've at that point been a year or two into downturns or doldrums, are the folks going to still have that high level of fulfillment, relatively speaking, and maybe because they've got advisors for so many of them?
That's a great question. And what we see, you're exactly right. At the beginning, if you get volatility, we're going to have volatility every year. There's a couple of times a year you're going to have what we call corrections, whether it's a 5% pullback or a 10% pullback. You're going to have those every year, but every 4 or 5 years, you'll have the big one, right? Where it drops 20%. And that's where, the strategy and all the things that we discuss with our clients could potentially be questioned by those clients. That's where I think it's so important to take a step back and look at, well, if you need to make adjustments, how does your current debt structure look? Also, what are your expenses right now? And what are those clients doing to improve their financial literacy? I think when you start to see a plan put in place to address those items, whether it's reducing debt, reducing expenses, or just doubling down on the financial literacy. And that means, the conversations that they're having with their financial advisors, but it's also some of the things that they're hearing out there. I always say if you're listening to things in the media as it relates to the financial planning world or finances in general, listen to different news sources, right? Because there's a lot of different sources out there, but it's good to have those sources to have that financial literacy in place, but also having that financial advisor by your side that's helping you get through those really rough times are very, very important.
Well, we'd like to not be living through rough times, but at the very least, we'd like our emotions to make them easier. I'm glad to know that folks have not been hurting themselves on this one. And again, financial fulfillment, even if they're not happy with what's always happened in the financial markets. Jesse, thanks so much for joining me on the show.
Thanks, Chuck. Always a pleasure.
That's Jesse Abercrombie, He is a financial advisor with Edward Jones. And again, we've been talking about their Pulse of North America study. You can learn about the firm at edwardjones.com. You can learn about the study at edwardjones.com/pulse, or you can just find the links that we have in our show notes and on our guest page. And speaking of financial planning, make your financial planning one to stick around because we're going to take a quick break and we'll be right back.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
It's time for the big interview on the July 16th edition of Money Life. Returning to the show today, Nanette Abahoff-Jacobson, Global Investment Strategist for the Hartford Funds. And if you want to learn more about the firm, the funds, and Nanette, go to hartfordfunds.com. Nanette Abahoff-Jacobson, it's always great to have you back on the show.
Thank you so much, Chuck. It's a pleasure to be here.
While I want to go global pretty quickly, I got to start with the fact that we're still domestic is still the big player. So we are in this tariff environment where we have seen, the announcements move the market, change things up, move it a little less. Next announcement, move it a little less. Are we getting to where we have normalcy? And what is normalcy going to look like if we are getting to an environment where free trade is basically a thing of the past?
Yeah, we always ask the question, what is normal? So I think that this is not normal. The good news is we're probably past peak tariffs. I described peak tariffs. That was April 2nd, Liberation Day. And we saw, the huge banner of countries and double digit tariffs. And of course, the pattern that we've seen since then is we have a threat and then we have retreat. So I think the market has come to expect that tariffs are not going to be as bad as threatened. However, uncertainty on trade policy is still elevated. And when you have uncertainty, and we're in the heat of it now with an August 1st deadline and more tariffs threatened on copper, on the EU, on Japan, on South Korea, on Brazil, the list goes on. You've got the actual direct impact of tariffs, but then you've got just the indirect impact on the US, which is will uncertainty in and of itself slow down activity and slow down growth?
It hasn't yet, according to most of the numbers. Is that coming? Or if it hasn't done it yet, it's not coming?
Yeah, the inflation boogeyman, where is it? You're right. I mean, inflation has actually surprised to the downside in the US. Why? I think that you have a couple of dynamics. One is that there's a lag. Maybe tariffs haven't really fed through the economy yet. Maybe they've been absorbed by margins. Maybe they've been passed through to suppliers in negotiations. Maybe supply chains have been rejiggered. Or maybe it's just a lag and we're about to see them in the next couple of months. Remember, Chair Powell keeps reminding us to wait for the summer because this is the time that they should start come in. On Tuesday, we just got a CPI number, which looked tame, but if you look underneath the hood, you see that core prices are going up. So I do think the answer is going to be coming in the next few months on inflation.
I'll point out the Tuesday release of inflation was the biggest rise in 5 months. But what we didn't see was necessarily a lot of tariff impact yet. It was still, okay, we had an increase, but it didn't appear to be the tariff stuff that was creating that increase.
Yeah, look, tariffs are probably going to be absorbed by several parties. It's going to be companies on the earnings side, it'll be suppliers, and it'll be the end buyer. And we're also right on the cliff of Q2 earnings season. and expectations have come down. They're, the lowest in many, many quarters, around 4 or 5% EPS growth. So maybe easier to beat. But the reason those earnings expectations are down is because of tariffs. So I just think we need to, we do need to wait and see if those come through. I think that we are going to see inflation perk up. I think the big question is because the employment picture is a little bit iffy. Has the threat of tariffs and the uncertainty, has that decreased demand? And so that's been perhaps an offset to the inflation impact. We shall see.
What we have seen is foreign central banks cutting rates where the Fed has not. Given that you are looking as a global investment strategist, how is the picture for global markets changing between the lower rates that they have had and them being on the other side of the tariff game?
Right. So I think the fact that central banks, at least in the UK, the UK's cut about the same amount as the Fed, but the European Central Bank has cut more, 175 basis points of rate cuts. So, and they've been very concerned about the effect of tariffs on their economies. But offsetting that is that Europe has gotten a huge wake up call from Trump and the administration that they better get their house in order in terms of spending more. And that's spending not only on defense, but on infrastructure and a host of other things that the European economy has fallen behind on in the past 20 years. So, as a result, Germany is spending €1 trillion on defense spending and other. And that other is infrastructure, which is everything from building to internet to data centers, you name it. So that marginal change is really important. And one of the reasons that I'm talking more about international stocks.
When it comes to international stocks, they've had a great rally to begin this year. And then there are now two sides to that coin. There are the folks who said, there's your rally, pretty much got it, it's over. And then you get the others who are like, no, the valuations are still compelling, it can continue. Are you in either one of those camps, or have you got something different in mind?
I'm really more bullish on international stocks. It's contrarian, but I think that the change in dynamics is what's important. Look, the US as a market, as a capitalist society, as the most innovative place in the world, I'm not saying that that we should diminish that. But I think on the margin, we're seeing a change in, growth prospects for the US. I just read an article that a survey of 1,600 scientists, 34% of them are considering leaving the US to go to other countries. And that's because of the cuts in funding for R&D and many, many science projects. So, you know, I think that in combination with the fact that the dollar is declining, and I see a soft dollar being a trend over the next at least a year. Those things and the fact that on the margin, fiscal is better in Europe, the fact that they've cut rates already, and the euro is strengthening for a US investor, you get the bonus of not only better earnings, better valuations, but also currency appreciation.
You mentioned the euro there. What's your take on emerging markets as we move you from developed to emerging?
Yeah, I think emerging markets are interesting also for allocators who can take the higher beta. If you think that the global economy is in okay shape, remember China's 30% of emerging markets. China is stabilizing. Their real estate crisis is like 4 years old now. And clearly, the Chinese economy is pivoting from being completely real estate focused to technology, EV, green energy, et cetera. So I think that the prospects for China at least are stable, but certainly better than they were a year ago.
Given where the US and China are right now, how investable is China to you? Like, obviously, we're not at full on trade war and we're hoping not to get there. But given the uncertainty, is China a bargain or is China a barrier?
Yeah, I think that, China is also it's up a lot already this year. So I would be looking outside of China, partly for the reasons you mentioned of investability. You certainly don't want to be at the wrong end of the stick when China says, you can't invest in these types of companies or whatever it could be. We can't predict what Beijing is going to say. We're looking at places like South Korea. Their whole economy is adjusting to focusing more on shareholders and returning more capital to shareholders. This is the project that Japan started 10 years ago. And now South Korea is saying, look, we want to return more capital to shareholders, get our cross shareholdings in order. So it's an interesting area. Also, Latin America, lots of interesting opportunities there. Central banks like Brazil starting to cut rates, and also governments, the politics shifting from very left wing to more right wing, which from a markets perspective is more markets friendly.
Let's move from where in the world to what in the world, because it has been, of course, the technology sector and AI that has been driving so much. Is that the place you most want to be investing when it comes to the industries you want to be in? Or is there another story for you that, maybe AI has been overplayed and something else has been overlooked?
Yeah, Chuck, I think it's not that. I mean, we all love tech. We all love, the innovation in the United States focused on generative AI and all the related aspects of information technology. As a strategist, I'm focused on is portfolio construction. When it comes to portfolio construction, the 10 largest cap companies in the S&P make up almost 40% of the index. So when you invest in the US, you just have a very concentrated portfolio. So I think, we still refer to the Mag 7, but we all know that there's a lot more to differentiate those 7 companies than a few years ago. Is Apple the same company as Tesla? Is the same company as Amazon, Microsoft, and Alphabet? I don't think so. The story for each of those companies is very unique. And do you want to be that concentrated in one sector and so few companies? That's the question I ask clients. And so, from that perspective, diversification is my mantra. It's one of the reasons why I say get some exposure to international developed markets.
I want to carry that further in a way that I didn't necessarily expect to go with this conversation. And I'm not going to mention the other fund company that's here. But one of the things that I noticed in the last week and a half, was that one of the largest fund companies in the world created a new ETF. And the ETF is an S&P 500 ETF minus the top 100. In other words, they're saying, let's create the index, but since the index is top heavy, let's do the same way you might do an international fund that excludes China or Japan or whatever. This is S&P 500 X 1 to 100. I question whether or not, as somebody who puts together portfolios, whether the need for this, the fact that this is being done and you can get more precise exposure to US large cap stocks this way. If you are going to tell me that the premier index that we use as the benchmark for the market isn't giving me precise exposure to US large caps, aren't you saying that the index is broken? Like at that point, shouldn't we be indexing to something else? And this has been doctored and adulterated or reused, or just the circumstances are so weird that we should create a new index and a new benchmark?
Yeah, I mean, I think indexing these days has lots of problems with it. I would say that taking an ETF that lops off 100 of the largest companies is a rather blunt tool. I would rather look at an equal weighted index. And I think that is just a more prudent approach by just equalizing the sector exposure. And then at least you're giving more weight to some contrarian sectors like healthcare, like financials, like utilities or energy, let's say. So that would be the way I would prefer to go. But I think you're right, Chuck. I mean, that's the reason that, stock selection and adding alpha really through idiosyncratic risk, I think is really important to do because that's going to be much more desensitized to what's happening at the macro level, at the industry level. So I think it's a clarion call for active management, and that is the indexes really open the door to better active management.
Well, I will point out that the large fund company that did this also created an S&P top 100 fund. So you can, create your own balance and go, oh, I'll do this my own way. But it was funny because I was talking to someone else who said, well, if this is supposed to push us towards active, why can't active managers beat the benchmark? And I'm like, well, if the statement is that the index is broken, why are we trying to beat a broken index? Like, I don't benchmark my portfolio. And I would imagine you would tell people, do not bench your portfolio to the market, benchmark your portfolio to your needs.
Yeah. Yeah. And I think also, I mean, this is off topic, but it is the reason that, management companies are thinking more about non index approaches, really looking at being able to be long stocks and short stocks, right? I mean, being benchmarked to the index means the least you can own is zero. Wouldn't it be better to have a strategy where you can take a more active bet and be long one company and short another company and earn alpha that way? So that is part of the whole advent of alternatives and strategies that are not benchmarked. It is, one of the forces at work.
And speaking of that, as a strategist looking at these market conditions, is there an alternative strategy that you find particularly attractive right now? Not necessarily better than the others in all conditions, but one that stands out to you at this point in time?
Yeah, I mean, there's a strategy, there are a few. One is in emerging markets, and that is neutral to the index, but all of the alpha is systematically generated, one company versus another company. So all of it is security selection. It's an emerging market systematic approach. And then there are international strategies that are focused on more value oriented sectors. I think that's also a good one, which is, going to be focusing on financials, energy, utilities. Telco is a really interesting sector right now. So all of these are a bit, that one is a bit contrarian. And I would much rather invest that way where valuations are low, expectations are low, and sentiment is low.
We were talking about international investing generally. Why have we not seen more impact on the markets of the conflicts that are going on around the world?
Yeah, it seems like the market's gotten pretty desensitized to B-2 bombers. However, you know, the oil market is a really different beast than it used to be. The US is a net exporter, we're energy independent. And as soon as the market could eliminate the possibility that the Strait of Hormuz would be closed, and that could disrupt oil supplies, the market just went back on its merry way to new heights. So I think it is the historical analysis that shows that geopolitical events are less impactful on the markets than economic events.
And I agree with that completely. The thing I keep waiting for is we have the geopolitical events lumped in with the tariffs and a situation that says free trade is not going to be so free anymore. That's where I think there's a shoe to drop that we haven't seen yet.
Yeah, yeah, yeah. No, I mean, look, the US multiples were 12-month forward PEs are 23 times. I think it's fair to say that US investors have become a little complacent and they're just pricing in a bit of a Goldilocks scenario. Either the market's pricing in 2 cuts, maybe the Fed doesn't cut rates, maybe inflation does spike, maybe the EU retaliates against the US. So, overall, we are slightly overweight global equities. We like equities more than bonds, but within that overweight, we are underweight US and overweight EM, Europe, and Japan equities.
And are you constructive on the market having room to run during the second half of this year, or have we seen much of what we're going to get?
I think we could still run, but I think it's going to come from the undervalued or the cheaper areas of the market. The proviso is that I do think the dollar is pretty important, and we've declined already, 10, 12% in the first half of the year. But I just don't see a catalyst for the dollar to reverse. So I think we're going to see more of that.
Nanette, great stuff. Always is when we catch up. Thank you so much for the time. We'll talk to you again down the line.
Sounds great, Chuck. Take care.
That's Nanette Abahoff Jacobson, Global Investment Strategist for the Hartford Funds. Go to hartfordfunds.com if you're looking for more information. And if you're looking for more of Money Life, well, we don't have much, but there is a little bit, and there's a couple of interesting points in today's interviews that I can connect them to some interviews from yesterday and last week that you're going to want to hear about before we cross the finish line. So stick with us till the end. This is Money. We are back to wrap things up on the July 16th edition of Money Life. And I will point out, although I mentioned it at the beginning, that, of course, July 16th, an important day in my house because it is Gail's birthday.
And I'll take this occasion of your birthday to say happy birthday to you, happy birthday to you, happy birthday, happy birthday, happy birthday to you.
Yeah, good to have Paul McCartney wishing my wife happy birthday. And we will celebrate her birthday. And, you take the good with the bad. Of course, Gail has come into my life, and this day is predominantly about her birthday celebration. But it is also the 15th anniversary of the death of my brother. Hard to believe it has been 15 years. And I am changing something that I do. Because after 15 years, I would say that in some respects, my relationship with my brother in some ways is changing because, things like Gail was not in my life at the time when I lost Rob and what have you. So I have worn a bracelet for primary amyloidosis, which is the disease that killed my brother. I have worn an amyloidosis awareness bracelet for 15 years, actually since the morning of his funeral. When we got out to California, they gave them to me and they kept breaking. And then I put one on the day of his funeral and it never broke. And I wore that for 5 years and I replaced it because it was burgundy and it wound up fading to some sort of a brown color. And then I replaced it and I wore another one for the next 5 years. And I'm now finishing the third for the last 5 years. And I will actually be taking it off. Not because I don't still believe in the cause, but because I show things in terms of the way I feel about my brother every day in other ways. And it has been time. If you've watched our videos, you see that I have a bottle of Writer's Tears, which is an Irish whiskey just over my shoulder. That's something also I'm doing in terms of there was a reason why I did something different to celebrate my brother. And now when I want to celebrate my brother, think about my brother, et cetera, I shed a tear, if you will, using Writer's Tears. So it's a personal day. You could always go back and do those things. And I know that we spend a lot of time here talking about the markets and everything else. And I tell you, keeping money in perspective is important. But my brother, one of the biggest influences in my life, still is in many respects, even though he's been gone for 15 years now. Yes, the relationship changes because I can't have the conversations and I can't do those other things. And yet the influence remains. You can always, the reason that I would switch those bracelets is that you can revitalize those memories with a thought. Right? You go from, okay, it's been 5 years, another 5 years, and the bracelet has gotten run down and looks ugly or what have you. And you have a thought and you change it and suddenly it can be bright and everything else again. And so there are ways that you can do things. Yeah. So we celebrate Gail's birthday today. We will celebrate my brother a little bit and appreciate what you've got because you don't know how long you're going to have it for. And as much as you can keep it vital and alive in your life, you still wish you could have it in other ways. So do that. Now, if you're looking for something to celebrate today, besides Gail's birthday, it is National Atomic Veterans Day. Man, when I was an intern at the Courier News in Bridgewater, New Jersey in 1983, I wrote a piece about atomic veterans who were veterans that the U.S. government basically put in areas where they were exposed to radiation while we were testing things like the bomb. And can't be many of them left, and yet their service and the health problems they endured and the rest needs to really be celebrated as best possible. It's National AI Day, which is actually a brand new holiday, which just makes me wonder, did AI decide itself that this was National AI Day? It's Guinea Pig Appreciation Day. I had guinea pigs a little bit when I was a kid. I appreciate them. I also appreciate that I don't have them now. And then it's National Personal Chef Day, which I don't need because I am my own personal chef. But if you've got a personal chef, they got a lot of choices today because it's National Breakfast Day, so you can have them make you breakfast. They could put some spinach in your breakfast because it's National Fresh Spinach Day. Then it's also National Cherry Day, and I want to remind people that I made my own maraschino cherries. If you want my recipe, you can have it, but I'm also making cherry pie for Gail. I do that using some cherries from that I buy called Fruit Perfect from American Spoon. And then it's also National Corn Fritters Day and National Hot Dog Day. Yeah, I can get behind that. I'll probably have a hot dog for lunch. That may be how I celebrate that too. My guests today were Michael Guyad, Portfolio Manager for the Free Markets ETF, FMKT, also the ATAC Funds, ATACfunds.com. Jesse Abercrombie, Financial Advisor for Edward Jones, edwardjones.com/pulse to check out the study. And then Nanette Abahoff Jacobson, Global Investment Strategist for the Hartford Funds. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Aravind Adiga, who said, "It's amazing. The moment you show cash, everyone knows your language." Well, yeah, cash may be the universal language, but you also have to have some universal truths and perspective when it comes to money. And that's one reason I tell you every day that until we do this again the next time, please remember that the best thing you can do for your money is not to worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again
The people who appear
tomorrow.
on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Leave us exit stage left.